Welcome everyone to our latest Zero Carbon Mine webinar. Today we've got Michael Scotton from Grant Thornton to talk to us about mandatory climate reporting in a mining sort of context. So yeah, be running through his presentation, trying to tailor it a bit to the mining industry. But if you've got any questions as you come through, put them in the chat or the Q&A box, and we'll try to get them as we get through. Yeah, if they're relevant, and otherwise we'll wait till the end and have a bit of time then. So yeah, without further ado, I'll hand it over to Michael and go from there.
Brilliant. Thanks, Brett, and good afternoon, everyone. I appreciate mandatory climate reporting may not be the most exciting topic on everyone's agenda. We'll try to make it relevant, though, for the mining industry. Let me just bring that screen up there. Brett, can I just get a check if you're seeing that screen okay?
Yep, no, that's right.
Brilliant, thank you. Okay, well, so why am I here talking to you about mandatory sustainability reporting for the mining industry? So by way of background, I'm a director in the Sustainability Reporting Advisory team at Grant Thornton. We're a team of about 20 sustainability professionals. We come from a range of backgrounds, including professional services and financial advisory, which is what Grant Thornton is probably more commonly associated with. But we also have corporate and industry backgrounds. And before Grant Thornton, I worked with Rio Tinto in a career of just over 24 years. So I'm very familiar with the mining industry, and my experience ranges from commercial energy management, working with electricity contracts for aluminium smelters, through to energy project studies. And from there, I started to get involved in climate-related reporting. This is the voluntary reporting that Rio Tinto was undertaking. That led into emissions target setting and then into transition planning. So a lot of these topics around disclosure are very relevant to the current mandatory sustainability report requirements. I've had the great opportunity over my career to sort of witness and be involved in some really key periods in industry. I've seen the setting up of electricity markets. I've seen the rise of renewable energy and its commercialization. I've seen the rise of voluntary climate-related reporting and corporate emissions reduction target setting. And I feel that we are on the nexus of another one of those important changes with the implementation of mandatory sustainability reporting, not just here in Australia, but also globally. So today I'm going to talk about mandatory Australian sustainability reporting and the AASB S2 climate-related disclosures standard. We will be making these slides available after Brett will somehow make that magic happen, and as he mentioned, we can squeeze in some questions at the end if there's anything pressing. So with that, sustainability reporting, it's not new to the mining industry, with many, but not necessarily all mining companies already voluntarily reporting sustainability information, and they might be using global frameworks like GRI, perhaps TCFD, or mining-specific principles and frameworks like the ICMM mining principles or Copper Mark and Responsible Gold frameworks. And sustainability under those frameworks typically has a really broad definition. So it would cover governance management over multiple topics like the environment and climate, but also bring in biodiversity, human rights, Indigenous rights, tailings management, etc. By comparison, the mandatory Australian sustainability reporting requirements, which were introduced by amendments in late 2024 to the Corporations Act, they require organisations in scope to disclose a sustainability report that is compliant with the sustainability standards. And currently, there's only one mandatory sustainability standard, that is AASB S2, climate-related disclosures. Treasury, when they were advising on this announcement, noted that it is a climate first, not climate only approach. And so the expectation is that further standards could be added to the suite of mandatory requirements. However, at this point in time, there's no standards in the pipeline, so we just focus on the climate-related disclosures. The key requirements of the legislated regime is that companies who are in scope have to prepare a sustainability report, and that will comprise of climate statements, notes to the climate statements, and a director's declaration. And together it's got to comply with the Corporations Act and AASB S2. The accompaniment by a director's declaration reflects the importance of the governance and the oversight at the highest level in the preparation of these reports, which is expected. Directors will be required to provide a statement that, in their opinion, the substantive provisions of the sustainability report are in accordance with the Act. The sustainability report is also subject to audit, though there are some transitional arrangements that will apply and will gradually lift the assurance requirement to reasonable assurance level over the entire report. And we'll cover those a little bit more in detail in a later slide. And lastly, there is a requirement for companies to keep written sustainability records that correctly explain and record the preparation of the substantive provisions of the sustainability report. So those records need to be kept for 7 years. They may have to be provided to ASIC on request. And importantly, the auditor must opine on whether these records are sufficient to enable the preparation and audit of the report. So much like other financial and annual reports that go through an assurance process, these sustainability records are a really important part of the process for companies to record their key judgments and decisions. Requirement to prepare a sustainability report is going to have a phased implementation, and it's subject to certain size thresholds, with sustainability reports required for the largest companies with a reporting period commencing 1 January 2025. So as a result, we've got some December year end Group 1 companies that have already reported earlier this year, and they are soon to be followed by a tranche of Group 1 junior end reporters who would be in the process of going through the assurance and readying for disclosure of their own sustainability reports. Entities that do report under Chapter 2M of the Corporations Act are required to prepare a sustainability report if they're above the thresholds listed on this table. The starting date from which these entities will be required to prepare an annual sustainability report is going to be phased in also per the table. So there's 3 potential ways to be caught within the scope of mandatory sustainability reporting. Firstly, is if the consolidated entity meets 2 out of 3 of the thresholds: consolidated revenue, consolidated gross assets, or the employee numbers. And these are all going to be based on the financial statements that are lodged with ASIC at the same time. We note that there's a group 3 is a fairly small threshold in terms of 50 million revenue, 25 million gross assets, or 100 FTE. That is the current legislated threshold, but in the May 2026 federal budget announcement, there was an indication that the intention is to raise the consolidated revenue and consolidated gross assets thresholds. They're going to double, which would decrease the number of Group 3 companies required to report. However, there's no current timeline for that particular change. It will require a legislated change to give it effect. The second way to be included in the reporting requirement is if the entity is registered under the NGER or National Greenhouse and Energy Reporting Act. This is irrespective of the previous 2 out of 3 thresholds. So there are several mining companies that do hit this threshold. They may not necessarily be Group 1. They would automatically be required to submit a sustainability report. Good to note at this point as well that if you're a company that is currently not registered under the NGER scheme, we have had some clients, it's been an opportune time as part of preparing for their S2 report, just to check where they are in respect of the thresholds for NGER. And it has been a surprise to at least one client that they were in fact meeting the NGER thresholds and needed to be registered under that regime as well. Third mechanism for being included is through the registered schemes, superannuation entities and CCIVs. That is really in relation to sort of financial institutions, probably not too relevant to this audience. Some perspectives just to reflect on here that we've seen coming through from some engagements with clients. It's important to understand that the scope here is the reporting entity lodging the consolidated accounts, and that entity may have subsidiaries and investments that operate outside of Australia. So unlike NGER, which applies only to Australian operations, these non-Australian subsidiaries investments would be in the scope of the sustainability report for the reporting entity. Second thing to note is that if an entity grows into the thresholds during a year, be aware that you are required to report for that year. And revenues and FTEs can be quite variable and quite hard to predict. So companies really do need to be mindful about how close they are to those thresholds. ASIC has made it clear that entities are responsible for having adequate systems to assess whether they may be required to prepare a sustainability report. And we have had a case where it came down to 2 FTEs being the decision point between whether a company was included or not. Lastly, one perhaps for the smaller companies, particularly the mining services companies, to bear in mind, even if you are below these current thresholds, maybe you're not even at that Group 3 threshold level, you just need to be mindful that your customers, the larger mining companies, likely are, and they may require information from you so that they can make their own disclosures, including assessing their climate-related risks and opportunities, and also to quantify their greenhouse gas metrics. So you may be approached to provide them with information. Which is the segue to what is it that companies have to provide to produce a compliant AASB S2 disclosure. So let's start with the objective. The objective of AASB S2 is to require an entity to disclose information about its climate-related risks and opportunities that is useful to the primary users of general-purpose financial reports in making decisions relating to providing resources to the entity. It's a bit of a mouthful, but specifically, this is about information about the climate-related risks and opportunities that could reasonably be expected to affect an entity's cash flows, its access to finance, or its cost to capital over the short, medium, and long term. So it's important to understand this connectedness between climate-related risks and opportunities and their effect on the entity's financial performance now and also into the future. There's a materiality judgment that entities are going to have to make around climate-related risks and opportunities that could not be reasonably expected to affect their prospects. So that materiality judgment can be quite helpful because any information that is considered immaterial does not have to be disclosed in the standard. Some key questions companies can consider is, who are the primary users of our report? What information in relation to climate-related risks and opportunities is material to their decisions? Mining companies operate in locations and rely on supply chains and are exposed to physical climate hazards. They create greenhouse gas emissions as part of the mining process, as well as in the processing and the use of the mined metals, minerals, and energy resources that they produce. Some metals, minerals, and energy resources also have a role to play in enabling the energy transition away from fossil fuels. And so it's very likely that mining companies and those that are providing mining services to those companies will have material information about their climate-related risks and opportunities that their primary users, principally their investors, financial institutions, and insurers, are going to find useful. The disclosure requirements in AASB S2 are broken down into these 4 pillars: governance, strategy, risk management, and metrics and targets. Essentially, it requires reporters to disclose how they oversee, monitor, and manage their climate-related risks and opportunities. What is their strategy for managing those risks and opportunities and the impact on the business model? What are their processes for risk management? And then any climate-related metrics or targets they use to measure and manage performance. So let's look a little bit at those in a little bit more detail. Now, this is a great slide that is loaded with information, and not expecting everyone to read it in detail. Certainly take a look at it after the webinar. What this slide does is it breaks down those 4 pillars into their key disclosure requirements. And when you do that, you can start to appreciate the relationship between each of these pillars. I think this diagram also gives a really good perspective on understanding the scale of the disclosures. Importantly, it's not just about disclosing your greenhouse gas emissions. Greenhouse gas emissions, you can find them in the bottom left corner of this diagram under the cross-industry metrics, scope 1, 2, scope 3. They are preparing an emissions inventory is time-consuming and does require a lot of data, but they are principally a couple of disclosures out of the best part of 100 disclosure requirements in the standard. When you look at it at this scale, there are some familiar business processes here: governance, strategy, risk management, and these processes are usually well established in companies and particularly in mining companies. But what might be missing in those processes is the integration and application of climate-related risks and opportunities. So we observe that companies that do have well-established processes generally find it relatively easy to add a climate perspective overlay to those processes. There can be some more challenging aspects to these disclosures that tend to require a little bit more education, capability building, perhaps also the development of some more tools and processes for collecting information as well. And they can take a little bit longer to implement, in which case a multi-year approach might be needed to lift those skills and expertise in the organisation. Some of those areas include identifying climate-related risks and opportunities. Generally, companies with an enterprise risk register will have touched upon some of these hazards, we would expect, but may not have gone through a deep enough review to understand the full breadth of disclosure that's required under the S2 standard. The standard does require scenario analysis. You have to test the resilience of the strategy and the business model to a hot world scenario, which is 2.5 degrees C or greater, and a world that transitions away from fossil fuel and achieves 1.5 degrees C. And climate metrics, this is where many mining companies have experience, some potentially being involved through INGO reporting, safeguard mechanism, perhaps even because it is a material topic under many of the voluntary sustainability frameworks. But as I mentioned, greenhouse gas emissions, just a couple of disclosure topics in quite a broad range across this standard. For those who are not familiar with Scope 3 emissions, there is a requirement in the standard to disclose Scope 3 emissions, but there is transitional relief available. So you can omit those disclosures in the first year of reporting. Many companies in our observation are taking advantage of that relief. There's also additional metrics that are required for asset vulnerability, capital deployment, carbon pricing, and executive remuneration. And depending where your companies are, they may or may not have something to disclose in this area. Climate targets has been an interesting area for a lot of companies. If an entity has a climate-related target, then additional disclosures about that target, including their progress and their plans to achieve that target, are required. And these can be time-consuming and data-heavy to prepare. But there is no requirement to set a climate-related target or to establish a transition plan. The last element over this slide is a bit of an overlay here about the assurance requirements. I'll cover that in a little bit more detail on the next slide. But the key takeaway from this diagram is that whilst not all topics are going to be assured in year one, all disclosure requirements outlined in the standard except for Scope 3 must be considered in the year one report. Just to sort of talk about those assurance aspects in a little bit more detail, there's a phased assurance timeline that's applying to disclosures. It's starting in year one with limited assurance over a small range of the disclosure topics. But importantly, it is moving towards reasonable assurance across the whole report. And this was an acknowledgement when they were putting the standard together that reporting entities will need some time to build internal capacity and maturity for their reporting. For a lot of companies, they will have exposure in their voluntary reporting, usually at a limited assurance level and usually on a discrete set of metrics, such as their Scope 1 and 2 emissions. The key to this requirement is that you're going to have to develop robust systems and processes to improve the quality of the report and also the sustainability records that you're maintaining over time. So practically, what does a company or an entity need to do when it's making a sustainability report disclosure? There are some things you're required to do and some things that you don't have to do. It's important to recognise that the scope of the standard is the value chain for the entity. So this is going to include all of the relationships upstream and downstream of the operations that are relied upon for conducting business. So this includes supply chain and the customers. I mentioned that the standard requires disclosure of material information. So you do not have to disclose immaterial information. And in fact, if you do disclose immaterial information, this could be considered to be obscuring the material information and will be frowned upon by the regulator. Note that I use the term material information. This is a different concept to double materiality, which some people may be aware of. Double materiality is not a requirement of the AASB S2 report. Essentially, when it comes to material information, the key here for companies is they need to document their decisions around materiality, and this is the documentation that the auditor is going to be very interested in reviewing. Scenario analysis, there's a minimum of 2 scenarios that have to be used. What you have to disclose is the effects on the business model and the resilience assessment for the entity. What is not required is you do not have to disclose the financial outcome of each scenario. Obviously, that information may form part of the internal decision making and will be subject to auditor oversight, but there's no requirement to put quantitative information into the final disclosure. So in summary, on those requirements, it's helpful for companies to think about this in the context of developing a strategic response to the sustainability reporting requirement. It's going to be an ongoing annual requirement, and it's an opportunity to start building capability and capacity within organisations, investing in the tools and processes so that these reports can be prepared efficiently. Some early observations we've got from ASIC on that first round of Group 1 reporters. It is noting, or it's worth noting, that ASIC's expectations are that these areas for improvement will be addressed by future reporters. ASIC is also producing a more detailed report on these observations. It's imminent, so watch this space. A couple of key areas to call out as a result of those first round of reporters. I mentioned that aspect around material information. You must not obscure material climate related information. So keep in mind, this is not a sales and marketing type report. It should be focused on material information. And when it is published, and a lot of companies are choosing to publish it as a section in their annual report, it should be clearly separated and identifiable from other sustainability information, which is unrelated to the requirements of the S2 standard. Climate-related targets are not just emission reduction targets. So, for example, a target to improve the resilience of your infrastructure to cope with extreme weather is a target under the definition in the standard. And ASIC did feel obliged to affirm that the safeguard mechanism is a climate-related target. So presumably some people had not considered that the case. So some tips if you are preparing a S2 report. In a nutshell, this is a climate-related financial disclosure, and the preparation is going to require collaboration across the business, and particularly between finance and sustainability functions. These reports are an ongoing inclusion in the annual reporting process, so it makes sense to educate and upskill your board, management, and your internal practitioners who are collectively accountable for the preparation and disclosure of a compliant report. There are several areas that companies are finding challenging because there are new areas of disclosure, such as the financial effects and the vulnerability metrics, or because AASB S2 has some nuanced differences with similar disclosure topics in other standards. So as an example, the requirements for greenhouse gas emissions reporting in S2 is different to those requirements under NGER in some small areas. And it is different as well from how you might be applying the greenhouse gas protocol. And those nuances need to be considered in preparing your S2 disclosure. Lastly, this report is subject to assurance. So a plug for all the auditors out there, and I'm not one, by the way, I'm an electrical engineer, but it does pay to engage with your auditor early to understand what their approach is and their requirements. Independence requirements mean that auditors are limited in what support they can provide. So if you do need support, education, or upskilling, then that is a great opportunity to engage early with an experienced advisor. Which brings me to my final slide. So the Grant Thornton Sustainability Reporting Advisory Team has a great mix of experience and technical expertise to support companies who are navigating compliance with sustainability reporting, and particularly AASB S2. We have an education-first approach that prioritises that upskilling to enable companies to be self-sufficient in sustainability reporting. I'd recommend our report here, Unpacking Australian Sustainability Reporting. If you're keen to understand a little bit more about those pragmatic aspects of reporting, that's available from our website. And if you really want to dive into the detail of the standards, then there's a few other references on this page to the knowledge hubs and to ASIC. Good to have them in your favourites and to check on them regularly. And if you'd rather have a chat, feel free to reach out to me on LinkedIn. I'd be happy to have a chat and answer any questions that you have. And with that, Brett, I'll hand back to you.
Thanks, Michael. That's a lot there, but yeah, no, it's very informative. Just if anyone has any questions, please just drop them in the chat box, and we'll get to them as soon as we can. I suppose one that I had that seems from those 3 different levels that over the next couple of years, most mining companies, from the sound of it, are going to be covered by the AASB sort of standard. So I'm going, how prepared are those companies that haven't had to report as yet, or I suppose even those ones that have started the process? From your experience.
Yeah, look, it is there is a wide range of preparedness for these reports. So my background with Rio Tinto, Rio's been preparing voluntary disclosures of this nature for over a decade. And so the big miners, the reports that they're preparing are typically pretty mature. They're already talking about a lot of these key topic areas. They are having to adjust a little bit, realign some of their disclosures so that they're really clearly meeting the requirements of the S2 standard. By comparison, we have we have worked with a Group 1 company that had done nothing in terms of preparation. And so in the course of about 8 weeks, we were able to take them through a process that got them started, got them a compliant report, and it's a good stepping stone for them now to start to strengthen those internal governance and processes and start to improve their report. If I reflect a little bit more broadly, we're now entering a phase where a lot of the Group 2 companies are starting to enter their reporting year. So we're seeing a lot of activity there. And we're also starting to see some activity from Group 3 companies who are wanting to spread the burden of preparing for this report over 2 or 3 years as well. So there's quite a range of approaches. I'd recommend for anyone starting, don't leave it to the last minute though. That particular example was a little stressful.
I say with everything that's sort of, it needs to be covered. I think it's, be much safer and easier to be involved, to start the ball rolling sooner rather than later, because I'd, definitely be, a lot to cover. I think, some of the smaller players, like the Group 3 sort of level, would probably be, harder push to get them sort of on board with the stretching the resource and all that. But yeah,
absolutely, yeah.
And I suppose because this is still fairly new, just in process. Do you think that it will evolve further, or I suppose this is sort of get implemented as it is, this staged approach, and go from there, or do you think it'll be more tweaking going forward?
Yeah, it's actually a really good point to reflect that this is a starting point, and I think we're going to see evolution of this reporting happening on many different levels. The aspect noted there around the assurance, and shifting the assurance over more topics in the report and to reasonable assurance is by itself going to be quite a driver of the quality and the rigor that is in these reports and the disclosures that are made. I think what we're going to see as well is ASIC. There's an expectation that they're taking a proactive but pragmatic approach to compliance with the standard. So they're not expecting perfection or best-in-class reporting, but they are expecting that the quality of reports will improve. So whilst the reports that we're seeing at the moment are tending to be quite text-heavy and qualitative in their disclosures, I think we can expect to see, as companies mature, get access to more information, that there'll be a move to more quantitative information being made available as well. And if you were to go through some of the big mining companies and look at what the climate report was 10 years ago compared to what it is today, I think you'd see some of those changes being reflected. But be mindful as well. Everyone is at a different point in this journey. So if you are just starting out, there are some pragmatic approaches that you can take to be compliant initially. That's obviously the key outcome, but then to improve the report over a time frame that suits your ability to upskill.
No, thank you. Anyone online have any questions? Otherwise we might wrap things up soon, but no. Just want to say thanks again, Michael. It's a very informative presentation. I'm sure a lot of people online or watch it later will take a lot out of that. I suppose it's sort of getting your head around getting the process started and thinking about it and how that sort of fits into the operations. So much appreciated, and thank you.
Thanks very much, Brett. It's been a pleasure. If anyone would like to have a chat about what they've heard today, feel free to reach out to me on LinkedIn.